Yesterday's most hated megacap just added $460 billion in one day. And I need you to understand how insane that is. For a year, this was the giant nobody wanted, down 29% from its high, second worst of the Magnificent Seven. Every analyst whispering the same word, over. Then one earnings report landed and the whole street flipped overnight. So tonight we settle the only question that matters. Is Microsoft finally growing again? Or did you just watch the most expensive dead cat bounce in history? I ran the report through the methods of 5 legendary investors. Their scores are sealed until the end. And inside that blowout report, I found 2 footnotes that nobody is saying out loud on TV. One of them changes everything. Stay with me. Watch how the detonation actually happened. 3% the second the report dropped, 9% by sunrise, 15.5% by lunchtime today, trading near 455, from 2.9 trillion to nearly 3.4 trillion dollars. One report did that. This is the morning after session. The board convened today, July 30th, 2026, hours after the report, with the numbers still smoking. On the docket, the year everyone hated this company. The report that flipped it. 5 legends. And those 2 footnotes. The verdict stays sealed. First, the hate file, because without it, nothing makes sense. 55-week high, 555. Before the report, around 400, down 29%, down nearly a fifth this year alone, while the rest of big tech partied. If you owned this stock in 2026, you were the loser at the table. That was the setup. And why did everyone hate it? 3 reasons. 1. The AI bill. Microsoft is spending more on data centers than any company has ever spent on anything, and Wall Street started asking where the return is. 2. Margins slipped. Small, but for Microsoft unheard of. 3. The OpenAI question. Too many eggs, one very weird basket. That is the company that walked into last night's $1 billion of revenue in one quarter, up 18%. Adjusted earnings, $4.74 against the $4.24 the street expected. That is not a beat, that is a demolition. And the number underneath it is the one that broke the bears. Azure, the cloud, grew 43%. Not slowing down like every bear model assumed, accelerating, up from 40% the quarter before. And for the first time in history, Azure crossed $100 billion of revenue in a single year. The thing everyone said was decelerating just did its best quarter in years. And here is my favorite number in the whole report. $678 billion of contracted future revenue, signed, committed, sitting in the drawer, up 84% in 1 year. That is not demand they hope for. That is demand with a signature on it. In the AI product everyone called a gimmick, Copilot just passed 30 million paid seats. It was at 20 million in April. 10 million new paying seats in 1 quarter, while half of YouTube was making videos about how AI does not make money. Somebody is wrong here, and it is not the invoice. Understand what this company actually is now? The Xbox in your living room, the Surface on your desk, Windows on a billion machines, that is the face. The engine is enterprise cloud, and it is invisible on purpose. 90% of Microsoft's cloud revenue comes from boring, paying, locked-in businesses that are not AI labs. Remember that number, it comes back. Machine is this good. Why was the stock on the floor? 2 words, the bill. And this is where tonight stops being a victory lap because the bears were not stupid. They were reading real numbers. $35.8 billion of capital spending in 1 quarter, nearly $116 billion for the year. Data centers, chips, power, the largest infrastructure bet by a private company in human history, running at full burn quarter after quarter. And here is what that bill does to the cash. Operating cash flow rose 30%. Beautiful. Free cash flow, what is left after the bill, fell 23% to under $20 billion in the quarter. The machine is printing more money than ever and keeping less of it. Hold those 2 numbers in your head. The board is going to fight about them. Now the controversial part, the first footnote. Meta reported the same week. Meta spends big on AI. The stock got destroyed, down almost 9%. Microsoft spends bigger, up 15. Same behavior, opposite verdicts. Why? Because Microsoft's CapEx outlook looked like it came down. Looked. It was an accounting reclassification, a change in how leases are counted starting next fiscal year. The spending did not shrink, the optics did. The market applauded a number that was partly a presentation choice. Nobody says that on TV. I just did. Footnote 2. The headline GAAP earnings, $4.81, includes a $3.2 billion one-time gain on an investment stake. Not operations, a markup. Strip it out and the adjusted 474 still demolishes the estimate, so the beat is real. But when someone quotes you the 32% profit jump, part of that is a footnote, not the machine. Now you know what the board knows. Real acceleration, real footnotes, real bill. Time for the board. 5 published methods run as models. The methods, never the man. Fisher on growth, Druckenmiller on momentum, Graham on price, Marx on the cycle, Buffett on the moat. Scores sealed until each chair votes. Chair 1, the Philip Fisher model. 15 questions, 1 obsession. Is the growth engine real and does it have years of road left? Fisher held winners for decades. His model does not care about one hot day, it cares about the machine.
The Fisher model sees the rarest thing in large companies, reacceleration at scale. $100 billion cloud growing 43% faster than the quarter before. A contracted backlog nearly doubling. A new product line adding 10 million paid seats in 90 days. This is not a bounce off a bottom. This is an engine hitting a higher gear. And the runway question, the backlog alone, $678 billion committed, is 2 years of revenue already signed. On the Fisher screen, growth this visible, this contracted, this early in the AI build-out earns the method's highest conviction in years.
The Fisher score, an 8. The highest number this board has given all season. Growing again? Fisher's model does not even understand the question. It never stopped. But the next chair does not read growth stories. The next chair reads the tape. Chair 2, the Druckenmiller model. Ride the theme, respect the tape, never fight a trend that fundamentals just confirmed, and critically, know the difference between a bounce and a break.
The model's test for a dead cat bounce is simple. A bounce happens on hope. A break happens on evidence. Yesterday was evidence, an accelerating core business, guidance intact, and the single biggest one-day repricing of the year, led by the fundamentals, not the crowd. The tape and the numbers agree for the first time in a year. One caveat keeps it from a 9. After a 15% day, the easy positioning is gone. The model rides confirmed trends, but it never confuses day 1 of a repricing with day 1 of a bull market. Size accordingly.
The Druckenmiller score a 7. The tape says break, not bounce. 2 chairs, 2 believers. Now comes the man with the calculator, and he is about to ruin the party. Chair 3, the Benjamin Graham model. The father of value investing. One rule above all, pay less than the thing is demonstrably worth, so you survive being wrong. His model walked into this party and turned the music off.
Graham's screen starts with what changed in a day. The business grew 0% between Tuesday and Wednesday. The price grew 15. Every dollar of yesterday's move bought the same machine at a worse price. And that machine now converts less of its profit into cash than it did a year ago, because the metal must be paid for first. Here is the strange part. Even after a 15% day, this trades near 22 times earnings, against its own 10-year average of roughly 32. Statistically, still a discount. But the earnings carry a one-time gain, free cash flow just fell by a quarter, and the capital bill is still climbing. A discount you can only see by ignoring the footnotes is not a margin of safety. The model calls it fair, not safe.
The Graham score a 4, not because the company is weak, because you are no longer being paid to take the risk. 8, 7, 4, the board is officially at war. Next chair, the man who wrote the book on market cycles. Chair 4, the Howard Marks model. 2 questions, always. Where are we in the cycle and what is the crowd already paying for? First level thinking says great report, buy. The Marks model is allergic to first level thinking.
Second level observation. In the same week, the market punished 2 companies for heavy AI spending and celebrated a third, and the celebrated one is spending the most. What it rewarded was not discipline. It was the appearance of discipline delivered by an accounting change. When the crowd cheers optics, the cycle is not early. And yet the model's own rule cuts the other way too. The best purchases are made when pessimism is maximal, and until yesterday pessimism on this name was maximal. The 29% discount was the opportunity. One day consumed a third of it. What remains is a good business at a fair price. In a late-stage capex cycle nobody can size.
The Marks score, a 6. His model's one-liner is brutal. The easy money was Monday. You are buying Wednesday. 8, 7, 4, 6, one chair left, the most famous one. And his model is stuck on a single question. The last chair, the Warren Buffett model, moats, pricing power, owner's earnings, decades not quarters. No method on this board loves Microsoft's business more, and no method is more suspicious of what the AI bill is doing to it.
Start with what the model respects. This may be the widest moat in modern business. 1 billion machines, entire governments and industries locked into one stack, and 90% of the cloud built on customers who could not leave if they wanted to. Switching costs measured in decades. The moat is real, triple-ringed, and getting wider. The suspicion is the owner's earnings. A moat is only worth what it lets the owner keep. And this year the owner kept a quarter less cash while spending more than any company in history. If 100 billion a year of spending is the new price of defending the castle pays a permanent tax. The model wants 2 more quarters of proof that the toll booth, not the arms race, wins.
The Buffett score, a 6. The moat is magnificent. The bill for defending it is historic. His model calls it a coin standing on its edge. All 5 votes are in. But before the tally, 2 quick reality checks. Lens 2. Where was the smart money before last night? We scanned the filings of 15 leading investment titans, actual positions, not talk, and they split exactly like our board. Bill Ackman opened a brand new $2.1 billion position. In the exact quarter, everyone else was calling Microsoft finished. Chris Hohn trimmed $1 billion. David Tepper trimmed. Dan Loeb walked out entirely. One legend bought the hate. 3 sold into it. Last night, one of them looked very, very right. Lens 3. The crowd. And even after a 15% day, the professionals cannot agree. Morgan Stanley, top pick, $650 target. Citi and Wedbush, 600. And Barclays the same morning cut its target to 512 on valuation. Same report, same numbers, 650 against 512. When the street disagrees this hard after the fact, you're not watching analysis, you're watching the exact argument our board just had. So the method split, the smart money positioned in the dark, and the crowd showed up this morning after the 15%. 3 lenses, 3 timestamps, 1 company. Tally it. The board score 6.2 out of 10. Fisher 8, Druckenmiller 7, Graham 4, Mark 6, Buffett 6, spread 4-8 open war. And the spread is the answer to tonight's question. Is Microsoft finally growing again? The business, yes. Emphatically. 43% at 100 billion scale is not a bounce, it is acceleration, and the board's growth chair scored it accordingly. But the stock's 15% day, partly real earnings power, partly applause for an accounting footnote. The business broke out, the share price bounced, and borrowed a little from optics. Both things are true at once, and anyone who tells you only one of them is selling you something. What would change the board's mind? 1. The real FY27 CapEx number, when they finally put a figure on it. 2. Azure next quarter, hold above 40%, and the 8 wins the argument. 3. Free cash flow. The quarter, the cash conversion turns back up, Graham's 4 becomes a 6, and this board score jumps. Watch those 3. Nothing else. The board saw the morning after numbers, July 30th, 2026. A record report, a 15% day, 2 footnotes. Those numbers will age. The 5 methods will not. Rerun them on any earnings day you like. That is the whole point of a playbook. So now you know what the board knows. My question for you. After everything, the acceleration, the footnotes, the bill, bounce or breakout, put your own score in the comments and tell me which chair got it wrong. And if this episode showed you something that TV coverage did not, subscribe. It genuinely helps the channel grow, and it tells me to keep doing these morning after sessions. Which report should the board tear open next? For the record, tonight's 5 voices are AI models built from these investors' published principles. Not the individuals, not their words, not affiliated, not endorsed, and nothing tonight is investment advice. The board scores businesses, never your portfolio. Microsoft the morning after filed, the stamp is already inked for the next report. When the next giant moves like this, the board convenes. Be in the room.